Good morning, and thank you for joining us for our webinar today, which is focused on navigating through uncertainty. We're going to aim to cut through some of that uncertainty this morning with insights from our expert panel on US tax, tariffs, and Pillar 2. So first, just a little bit of housekeeping. Please do send in your questions and we'll address them at the end of the session. If we don't get to them, we'll come back to you separately. So to introduce myself, my name is Susan Buggle. I'm an international tax principal with KPMG Ireland. And I'm joined this morning by Richard Cowley, a tax principal with KPMG Ireland and our head of customs, by Cillein Barry, an international tax partner, and remotely by Yael Selfin, who's the EMEA chief economist with KPMG and also a regular media commentator on economic issues. And finally, by Julio Castro, an international tax principal with KPMG US. Okay, so to start the discussion, one of the key sources of uncertainty for Irish businesses has been the ever-changing landscape of US tariffs. Headlines have been dominated recently by President Trump's threat to introduce a 30% tariff on EU imports into the US. Richard, can I come to you first? You give us your perspective on that announcement and what it could mean for Irish business.
Yeah, thanks, Susan. It's hugely disappointing, right, to see us in this position at this point in time after the weeks of negotiation that have been held. What was a deal, or at least the thin deal, was effectively an additional 10% reciprocal rate that would have been applied by the US on imports from the EU. Now, I think for those particularly within the drink sector and the aircraft, they'll be disappointed, hugely disappointed by this, simply because the bones of that deal it appears as if there were going to be specific carve-outs for those sectors. So, I think if we get to a position that there is not a deal, we simply now have a situation where we have increased uncertainty. You've got that's going to be prolonged. There's supply chain disruption. There's potential, price increases that are going to take place. All of this feeds in ultimately to, a really challenging environment and a really challenging situation for businesses to make, investment decisions. I think that if the 30%, if that were to stay, if there wasn't a deal that comes into place, the questions that businesses are asking themselves is around, should we front load our stocks into the US now? Eat the 10%, we avoid 30%. What are our competitors doing? And I think, in terms of that analysis, obviously competitors in the rest of the world, like the EU, are facing significantly increased tariff costs. So, longer term, were this to remain, there would be huge focus in terms of looking at restructuring supply chains and, continuation and a deeper focus on new markets.
Okay. And what about the other side of EU retaliation? What's your view on that and when could it kick in?
Well, I think Maroš Šefčovič, right, so he said that, the EU is exploring all possible outcomes. The EU's been consistent in terms of its messaging up to this point in time, which is that, whatever retaliation takes place will be proportional. If the 30% stays, I think there's a very real prospect that the EU will retaliate. Based on that, I think the key dates to look out for here are going to be 1 August and the 6th of August. So 1 August is when the 30% additional reciprocal tariffs are due to come into effect. The 6th of August is when the first wave of EU countermeasures are going to come into effect. Just remember that that first wave of countermeasures, that's been delayed twice, right? That was delayed back in April, it was delayed back in July, and that was done with a view to encouraging negotiation with the US. Now those measures only tackle about 21 billion of US imports into the EU. There's a second list, all right, and there's a much wider list that tackles another 70 billion of US imports. And that list, that's been sent out to member states. It's yet to be signed off on. But on that list we hear is that we've got aircraft, we've got medtech, bourbon, agri-food, and those are important sectors for Ireland. And the critical issue there is that from an Irish business perspective, President Trump has threatened that, well, if you introduce additional tariffs on us, we'll escalate from the US side.
Okay. And you mentioned there about accelerating imports. Are there other practical steps you're seeing clients take at this stage?
Yeah, there's various different options that people are looking at, and I suppose you've got a mixture of, there's different profile of the businesses that are really exploring these. So large kind of MNCs, they've already carried out their strategies. They've been looking at this for quite some time. The same with large Irish businesses that are trading heavily with the US. I think for a lot of other businesses in Ireland, they've looked at potential opportunities, haven't really implemented them, taking a kind of wait and see approach. So, in terms of what people are looking at, you're really looking at, can I have a different sourcing alternatives, different production alternatives? Can I use customs procedures that will either reduce down or in fact mitigate duties altogether? There's a real focus on customs valuation methodologies, so that's a way to ensure that you don't overpay your tariffs. And there's a lot of attention being paid to the intangible element within the pricing of goods going into the US.
Okay, that's an interesting point. And pharma and medtech, we're all aware they're key sectors for Ireland. Is there any update at this stage on how this might impact them?
There's not, right? Well, the update is that President Trump said yesterday that there's probably going to be tariffs on pharma by the end of this month. The 232 investigation into pharma is meant to be concluded by the end of this month as well. That's going to be hugely relevant. But the indications from President Trump are that pharma will be hit with tariffs. He said that these will be low initially to give time to the industry to build production capacity within the US, and then they will escalate quite sizably, maybe over 12 to 18 months. 200% is being moved. That's a real headline, right? Whether that happens or not, look, we've yet to see.
Okay. So, Richard, in terms of the EU-US trade deal, there was obviously discussion as to how soon that would be done. Where do you think that will land?
It's a great question, right? And it's a really difficult one to answer. There was the framework of a deal, thin as it was appears to be agreed and was just subject to sign off by President Trump. But now that that's been upended by the letter that arrived, or that was issued by President Trump threatening the 30%. We're back into, and certainly the EU are very much focused on negotiations. There's a, suggestion of a heavier, more aggressive approach by the EU. Whether that comes into play or not, it's yet to be seen. But I think that, towards the end of this month, we're either going to have a deal, right? Or there's going to be a pause, or there's going to be no deal. And if there's no deal, then that really carries with it the risk of 30% being imposed by the US, countermeasures being deployed by the EU. We could then get into full retaliation. Okay,
brilliant, thank you. I'd like to bring in Yael now to give us a bit of the economic perspective. Yael, could you let us know what you think the economic sentiment across the Eurozone is at the moment?
So, when it comes to the economic environment, it's actually not too bad in the sense that we had a relatively resilient momentum driven by a relatively resilient labour market, and then we had a new government in Germany that announced quite a significant increase in spending, so that is obviously quite significant for Eurozone as a whole. We've also seen some easing in the borrowing criteria, or if you like, in the rules, the fiscal rules, in order to allow additional spending on defense and related industries. So overall, the momentum is relatively positive at the moment, despite the issues that we've got with trade, especially with the US.
Okay, and there's positives to take away there. And if significant tariffs become a long-term feature, what would the economic impact look like there?
So it will definitely have an impact, especially in the short term. We're estimating, and depending on the severity, we could see GDP lower by between 1.5% to 0.5% by 2026 for European economies. The Irish economy will be the one that will potentially be one of the worst hit, given its strong trade relationship with the US.
Yeah, and I suppose we're all aware of the openness of Ireland's economy in that regard. It was reported last week that the EU Commission had dropped plans for an EU-wide digital levy, and that was likely in response to the US trade negotiations. What would your view be of other changes the EU could make around competitiveness?
Yeah, it's a very good question. So one of the things that the EU has is on the face of it, it's a very large market of a one market. So you want to advance further, especially with the saving and investment union and other hurdles that at the moment don't make that market one and make it much harder to trade across the different countries. Then the other thing that the Commission in particular can do, but also the national countries, is focus more on growth and less on regulation, especially when it comes to new technologies, where the emphasis has been traditionally on regulating first and then seeing how those new technologies evolve. So trying to nourish new industries and emerging technologies first and then regulate probably is a better approach.
Okay. And just finally, I suppose Ireland has been described in the past as closer economically to Boston than Berlin. Do you think there's any risk and change in that dynamic?
Well, there's definitely risks around. But when you look at the importance of the EU, overall export volumes generally have been stronger with the EU. FDI has picked up quite a lot from the US in COVID, so that will be felt potentially. But the EU remains a very important trading partner for Ireland. And also when you think about the synergies when it comes to monetary policy and the other linkages there, I think there's still a lot of upside given that we could see stronger investment and consolidation in the EU in terms of upside growth for Ireland.
Okay, that's really interesting, Yael. And I suppose you touched on competitiveness there. I think probably worth noting as well, our pre-budget submission does set out some measures on the tax side that we think could support innovation and enhance Irish competitiveness. Okay, I'd like to bring Cillein in here on a related matter. One of the other key developments has been the announcement that was made between the G7 and the US on the agreement of a carve-out from Pillar 2 for US headquartered groups. Most immediate result was the dropping of the onerous provisions in the US bill, super beat, withholding tax, known as 899. Cillein, can you give us an overview of what was covered in the announcement and what was missing?
Yep, sure. Thanks, Susan. I didn't expect to learn about major tax developments on social media, but about 3 weeks ago now, a tweet dropped from the Treasury Secretary, Scott Bessent, and he confirmed that a deal had been reached between the US and the G7. And about 2 days later, then a short statement was released by the G7. And I say short because it really was short. But what were the key items mentioned in that statement? So it referred to a side-by-side system which would essentially fully exclude any US parented group from both the UTPR and the IIR, and also both for domestic profits, either US profits, but also their foreign profits. That's obviously the key headline from this statement. It also referred to having a level playing field, which we'll see what that means in due course. And also continued to address the BEPS, the base erosion profit shifting initiatives. It also flagged that they would introduce material simplifications overall for Pillar 2, addressing administration and compliance, and that they would also look to further align the treatment of non-refundable tax credits, which is obviously a big issue for US groups, and that with that of refundable tax credits. Interestingly, there was also a comment at the end of the statement in relation to further discussions in relation to the digital economy and also the sovereignty of jurisdictions over tax. Now, I don't think that means Pillar 1 is back on the agenda, but certainly digital economy hasn't gone away. So as I mentioned, it was a short statement, so many questions remain open from that. But what wasn't addressed? So to give you some examples of kind of key questions that are still being asked today. So for example, how were US subsidiaries of non-US groups being taxed? That wasn't addressed in the statement. How will guilty be treated? So we know for a long time that the US kind of felt guilty was almost equivalent to Pillar 2, but that was initially rejected. And I think the US would like a guilty first approach where guilty applies before a QTMTT. That wasn't touched on, but maybe more than that. There was also no mention of permanent safe harbours. Obviously, groups have been looking for permanent safe harbours for quite some time. The ones we have are temporary. Again, that wasn't mentioned, but you'd hope that would fall within the simplification measures that were mentioned in that statement. It also wasn't flagged exactly what date these would apply from. Now, we expect, and the statement kind of alludes to the fact that it's retrospective, and that's, I think, what we will see in due course. So where does it leave us right now? The ball is in the court of the OECD, the inclusive framework. So the simple task of getting 147 countries to agree to a consensus approach on this one, that work is ongoing as we speak at the moment. Also on the European side, we have a European directive, as people will be aware of. I think it's pretty clear the EU does not want to open that directive. They want to keep it as it is. So how the EU directive can fit in with these changes will be interesting. And I think probably most importantly as well is how other countries will react to this. You know, for example, do countries delay implementation? Do they change their domestic top-up taxes? Do they maybe withdraw their domestic top-up taxes? There's a lot to play in that space, which isn't directly relevant. But so, yeah, a lot going on right now, Susan, that's for sure.
Yeah, absolutely. And I suppose a common question we get, does this mean US headquartered groups can ignore the compliance burden in Pillar 2?
Yeah, certainly got a couple of those questions and calls, and probably more in hope than expectation. But on the slide here, on the screen, we've got a simple slide, I guess, just to show an example of a US headquartered group. This group would have essentially had income inclusion rule at the Irish Holdco level. I'm sure is it.
I'm sorry, I'm just going to get the slide
no
moving
worries,
here.
No worries,
with a
we'll
little
have it in a moment.
Yeah.
But this group essentially, it could have had an income inclusion rule at the Irish Holdco level, maybe a foreign Holdco level. These are the companies just below, here we go, just below the US. It also could have had UTPR on the profits of the US group, sorry, US company, and also any other companies in this group that aren't in a QDMPT jurisdiction. Both of those are now gone. So you can see there's X's here on the screen. So that's a fundamental and enormous change for US groups. That a lot of these IORs and UTPRs have fully fallen away. But what hasn't changed is the ability to have domestic top-up taxes. So QDMPTs and DMPTs were not addressed by the statement, and they still will apply. There's also an open question on guilty, which I mentioned. So back to your question, Susan. As we stand here today, over 50 countries have introduced Pillar 2 legislation. So the answer is no. US groups, as much as they might wish and like to, they can't simply drop this and say there's no more compliance. I think maybe even worse, they've got compliance to address in up to 50 countries with different local implementation rules, different registration requirements, and different local filings. So there's still a lot on the board right now in relation to compliance.
Okay. And maybe to take the perspective of the Irish headquartered groups or the inbounds into the US, what's this carve-out going to mean for them, and how does that differ to what you've discussed on the US headquartered? Yes,
so it means a lot less, essentially, in the sense that not as many changes as for US groups. So again, we've got a simple slide here on screen showing a non-US parented group. Depending on where that non-US UP is, if it's Ireland, we will have an IIR to apply. That's still in place, isn't impacted by the statement. There will still be UTPR considerations for the group, again, still not impacted by the statement. And of course, the DMTT or QDMTT rules still apply. So these groups are still fully in the teeth of the rules, essentially, little impact on the agreement. I guess, what is outstanding are things like, if the US gets accommodation that guilty is allowed to come first or is qualifying, then does Japan say, well, we want our CFC regime to qualify? Other countries with similar CFC regimes. Or the US now has this UTPR carve-out. Well, does China come along and say, well, we want UTPR carve-out? So it depends how other countries react and what changes they want to get similar treatment to the US. That's what's uncertain, and that's what may impact this group.
Okay. So, from what you described, there's still a lot still up in the air. Do we know what further details are likely to emerge, and do we have an idea of when and what businesses should be watching for in those announcements?
Yeah, certainly a lot up in the air. Looking at uncertainty is definitely the buzzword at the moment for lots of reasons. There's no agreed timeline as of yet, and in the statement, work is definitely ongoing at the OECD level. We're aware of that. We're also aware of discussions at an EU level in relation to this. I think things might move. There's a good chance things could move quickly, and we may even see, Susan, in our finance bill coming up in October, November, some changes in our Irish legislation to cater and address for these. But as right now, we don't have a clear certainty. I do think we might see delays, as I mentioned, in certain jurisdictions. I certainly would be advocating that we would delay Pillar 2 in its entirety for 1 or 2 years, because as we stand here today, the rules are unknown because they're still being developed. Now, that may be wishful thinking, but I certainly think that's important. So look, all I can say to people is to stay tuned in the coming weeks as we wait developments, and certainly keep an eye out for developments in local jurisdictions that they take unilateral decisions in relation to this as well.
Yeah, and I think many people listening today would welcome a pause to have more time to get their heads around this. Julio, I might bring you in on the US perspective. We touched on there that 899 was dropped in the final US bill. Is that section gone for good?
Hi, Susan. Hi, everybody. I hope so. Surely the last month and a half has been tough with clients scrambling to try and find solutions to 899. But eventually we got to the place where we are now, which is actually a good one in a sense. As Cillein mentioned, there's quite a lot of work to be done on the G7 inclusive framework group to implement this agreement with the US. What I would say is that 899 is I would say dead in a sense, but clearly if things don't progress as quickly as the US hopes on the G7 and the inclusive framework, that's always a threat that something like that could come in, or that some other form of retaliation would be posed, such as tariffs or other measures. So for now, I think we're fine again, but we need to see how things will progress in the next few months and years in terms of implementation of this agreement. Okay,
and that makes sense. And Julio, I suppose looking at the one big beautiful bill beyond the 899, obviously I know there was a lot of changes around international tax provisions. People will be familiar with FDII, GILTI, BEAT, which all have new names now. Appreciate we could spend a day on this bill alone, but just get your perspective on some key headline changes. Particularly maybe before we get into the detail, could you give us a bit of context as to the driving factors of the Trump administration that motivated them to pass this bill?
Sure. Yes, so the bill was passed on July 4th, was actually signed by the president on July 4th, which is, let's say, emblematic in a sense. Mm. And the idea was to essentially renew or extend some of the tax cuts from the first Trump tax reform, the TCJA, which was passed into law in 2017. A lot of the tax cuts and certain provisions were getting worse over time, and by reason of the mechanics used to implement the first tax reform. And there was a consensus, certainly within the Republican Party, that they wanted the cuts to be extended and some of these negative changes to be put back to where the tax reform was in 2017. So that was the main driver of the One Big Beautiful Bill Act, OBBBA, as we call it. Of course, this was a huge deficit generating exercise, all these extensions and alleviations. So some tax increases and revenue raisers were included as well. So especially around tax credits that were implemented under the Inflation Reduction Act, which was a President Biden tax bill. And some of the changes we're going to talk about around the USCFC rules and foreign-derived intangible income rules.
Okay, thanks. And yes, I think some of us were sceptical it would get done by the 4th of July, but it certainly got there in the end. So I'll actually just focus on what you mentioned there, foreign-derived intangible income. So this was FDII, as we all know it. It's now called FDII. But I understand there was significant changes beyond just the name. Could you give us a high-level summary of what was changed?
Yeah, sure. So before we had a deduction for export timing income of U.S. entities, so both sales of inventory or services or royalties received from offshore, they were subject to a preferential tax rate. This particular provision has changed in a variety of respects, and I think for the better from the perspective of U.S. exports. First, the deduction was decreased by something called the DTIR, which was a D return on capital assets. So essentially, you would get less FDDI deduction if you had a lot of U.S. capital, which was a bit crazy, but that was eliminated. The rate was changed as well. There was used to be a deduction of, I think, up to 50% of your export income. That got decreased to a deduction of 33.34%, which means that this type of export income will be taxed as essentially a rate of 14%, which is kind of quite close, I'd say, to the rate of tax, minimum tax under the general Pillar 2 rules. There are also some changes around how you allocate expenses. So interestingly, you can essentially claim more deductions because you don't need to take into account some reductions in your taxable income other than for interest and R&D expenses.
Okay, and appreciate there's detail there in the mechanics of how it works, but key takeaway, I suppose, the 14% rate is likely to apply on something closer to gross income from the foreign IP. Cillein, can I bring you in here? Because there's an obvious comparison there to the 15% rate and Irish IP profits. What are the other factors clients should be balancing here?
Yeah, look, I mean, I think that's essentially, it's very headline grabbing 14% rate. Susan, I think there's no doubt that certain US groups, there may no longer be an incentive to move out of the US, they can stay in the US. But we have to be careful of any knee-jerk reactions here, because I think there's a number of different factors to consider. And look, ultimately, longer term, I think Ireland is and will be a great base for US groups to operate in the European marketplace and beyond. And I believe that US groups will have significant operations here into the future. Ireland, of course, still does have the 12.5% rate, the one we're famous for. That's still there. The Pillar 2 rules are obviously up in the air a little bit at the moment, but even at 15%, that is an ETR-based test, and therefore, not all groups pay extra 2.5% when you bring in considerations like withholding taxes and non-deductible expenses and things like that. But look, the Irish regime has given stability and certainty, which shouldn't be underestimated, I think, because groups still want that. We have that low rate for over 20 years now, and going back even further with different incentives we had. I do think there are some quirks in the US rules as well, which, and interestingly, just give one example, how from a US perspective, Irish subsidiaries holding and owning the IP that's used for US destined goods and products can actually be quite beneficial from US tax perspective. So there are some kind of counterintuitive positions there as well. But I do think Ireland still is and always has been a hedge as well for US tax reform in the future. This OB3, I think as it's called, is projected to add 3.4 trillion to the US deficit over the next 10 years. That US deficit is growing massively. I think they're saying now budgeting something like 1 trillion of interest expense a year in the US. So there's always a possibility that at some point in time a US administration has to change their rules to raise taxes to cater for this. And that's why I said Ireland can be a hedge against that. I think there's a risk here of kind of chasing that short-term game for perhaps a long-term pain on the future. We can't also ignore the ecosystem, the talent pool Ireland has, and that competitive incentive regime we have here as well. And the cost of hiring is definitely lower in Ireland compared to the US. But look, I still think at the end of the day, Ireland needs to continue to work hard, right, and make the necessary policy changes to remain attractive. We can't rest on our laurels here. And things like, we actually should give consideration now to, do we keep a QDMPT? Do we move to a DMPT? All these kind of open items, because, we can't forget that QDMPTs are a choice. Pillar 2 doesn't force you to do it. It's up to you to do that. And Ireland obviously chose to do so. But do all these changing dynamics mean that we should revisit that? So there's a lot there. It's definitely, Susan.
Okay, yeah, there's a lot in play. It's not a black and white answer. Julio, I might just move back to you to talk about the US, I suppose, version of CFC, so that we all know is guilty. This has now been renamed to Net CFC Tested Income, which doesn't trip off the tongue quite as easily. But can you tell us what else has changed?
Yes, so it's a pretty material change, Susan. Guilty was essentially a minimum tax on CFC earnings, which were not subject to a high tax from a US tax perspective. But there was a fairly material deduction available, about 50% of the amount of the inclusion. So overall, there was still an incentive for US multinationals to have profits derived offshore in CFCs, with proper planning and avoiding the, let's call the headline CFC rule, the subpart F rule. The change is actually quite material. The first thing is that the deduction has decreased from 50 to 40%. And the way this rules mechanically work now is that if you're earning profits offshore at a rate which is below 14%, you're going to end up with this US top-up tax. So again, a bit of a departure, a material one in terms of how these rules operate. The other very important change is that there was an exempt portion of your foreign income, which was 10% essentially of your your capital assets in your CFCs. So that kind of return you could earn without having to include in the US under the GILTI rules, the former GILTI rules. This has been eliminated. So essentially now 100% of your CFC earnings, which otherwise would be caught by the GILTI, could potentially be subject to inclusion under these NCTI rules. There's also a change in the amount of the credits, for tax credits you could claim in respect of those earnings. Before, there was a haircut. You could claim 80% of your foreign taxes, which were imposed on these foreign taxed income. That has increased to 90%. And when you look through all of these, at the end of the day, what you're going to have is essentially taxation in the US of earnings of foreign affiliates that are taxed at a rate of 14% or less.
Okay.
If you are above that threshold, then you probably wouldn't be in a situation where you have a bad tax under the NCTI rules in the US. Again, a big departure from the prior rules. And I think all in this is intended, I'll say, to make it less interesting for multinationals to push profit offshore. Again, before with the GILTI, the way it worked, the effective rate was much lower, significantly lower. But still, again, 14% tax offshore is not necessarily super low. So again, going to Cillein points, I'm not sure whether that's going to create an incentive for businesses to change their model to onshore operations in the US just as a result of this change.
Yeah, and as you point out, I suppose 14% rate, higher than it was, but lower than the standard 21% rate in the US if the income was actually earned in the US. Okay, so maybe just looking at the area of BEAT, this is an area where there were significant changes proposed in the earlier House and Senate versions, but they got pretty stripped back in the final version. What exactly did we end up with in the shape of the final provisions?
Yeah, so there were a lot of talks about changing the BEAT rules, but the final changes were really not very material in themselves. So the BEAT rate essentially was going to increase to 14%. It ended up not being increased by that much. It was increased from next year to 10.5%, which is not necessarily a big departure from where things were. There were talks about decreasing the test threshold for a company to be in scope of BEAT. That was also not implemented. There was also a talk about including a high tax exception such that pure income that is paid to a related foreign person was subject to a high rate of tax, then BEAT would not apply. At the end of the day, there was a requirement to raise a material amount of revenue from some of the provisions, and that provision and those proposals would end up losing money at the end of the day. So Congress decided to drop it. That all being said, although the changes themselves were not super material to the BEAT, because it had so many other changes, which we're going to talk about in a bit, the taxable income of U.S. corporations are dropping quite materially because of some of the new deductions that are being allowed. And that would include Section 174, which is a deduction for U.S. R&D expensing, and also an increase in the amount of interest expense deductions under Section 163J, which is also a big change we're going to talk about. So when you look at all those changes, what we're seeing from some of our clients is that the BEAT cost of their structure is actually increasing in a lot of cases. So there's quite a lot of discussion and modeling going on now as to how to optimize these new deductions while managing the BEAT position of these clients.
Okay, that's interesting. So while maybe not much change in BEAT itself, your BEAT profile might change by virtue of the other changes.
Yes.
And Cillein, I suppose BEAT is a key issue for inbound. Certainly it was a key one for a lot of my clients. What do you think their reaction will be to the final version? Yeah,
I would say mainly a sigh of relief in the first instance, Susan, given that super BEAT that you touched on earlier on hasn't come in, so 899 was dropped, as we know. And given that the change that Julio just mentioned that were proposed and fallen away in relation to the threshold and the increase of 14% again not introduced, so overall that's positive. I think for those in beat already, clearly there's an additional cost, and as Julio just mentioned, that cost might be higher than anticipated based on the interaction. So I think really going back to some beat mitigation strategies, certainly back on the agenda for clients, and sort of modelling out, as Julio said, the impact to ensure that you fully understand the beat and how it interacts with all the other changes and what that actual end cost would be.
Okay, interesting. Okay, so just turn to some of the other provisions. Julio, broadly good news for interest deductions and R&D expenses. Could you maybe give us the key takeaways there?
Yeah, sure, Susan. So the big headline on interest expense deductions is that under the original TCJA, the deduction was limited to 30% of EBIT from 2022. And that actually decreased quite a lot of the amount of interest expense deductions that were available to U.S. groups. The OBBBA actually reverted to the TCJA original threshold of 30% of EBITDA. So it actually affected from these tax year, taxpayers can already deduct back to the same status quo as they were before 2022. There are also some changes around how to compute adjusted taxable income, which is the equivalent of EBITDA. Some deductions were excluded or will be excluded, and some special rules were being implemented around capitalized interest. So again, some changes around how you compute, but overall, very positive news that more interest expense will be deductible. That was a big request by the U.S. business community. The other change is around Section 174. So just going back to 2017, there was an allowance for U.S. companies and U.S. businesses to expense 100% of their R&D expenses, whether located in the U.S. or offshore. That started to change again by operation of the TCJA itself, such that there was a requirement to amortize U.S. R&D expenses in 5 years, and foreign R&D expenses were required to be amortized over 15 years. It's obviously a lot worse result. The OBBBA changes that, but not exactly to the TCJA situation. Under these rules now, there will be 100% expensing for U.S. located R&D expenses, but foreign R&D expenses will still have to be amortized over time, which is, again, a big departure. And again, an impetus or an idea or a desire by Congress to push more of the R&D activities of U.S. Groups back into the U.S. As I mentioned before, with this 174 deduction plus the relaxation of 163J, what we see now is taxpayers scrambling a little bit with their BEAT position because their taxable income is decreasing in such a way that is increasing potentially their BEAT liability if they're subject to the BEAT rules. In other words, if they meet the applicable taxpayer thresholds, which haven't changed, as I mentioned before. So Section 174 itself allows taxpayers to adjust the amount of their deductions to some extent and time, whether they take a deduction or the amortization in a particular year. And again, that would be a function of their modeling to see what the best outcome would be under the BEAT rules. So again, a lot of modeling and a lot of planning going on around how to kind of take advantage of those measures, but not actually have a disadvantage if you were to fall under BEAT, which I think from a financial accounting perspective is a bad answer.
And I think that's really interesting. So positives to take away, but I suppose businesses need to run the numbers to see what that really means for them. Okay, Julio, so I'm conscious we're coming up to time, so I'm going to take one or two questions that have come in here. The first one is to yourself, Richard. This is around the court cases that are pending in the US around President Trump's tariff agenda. What do you think is the prospect of those actually impacting the agenda?
So yeah, I mean, there are a few cases that are going through the courts. I think the one that got the most attention was the three-panel of the judges who basically struck down the reciprocal tariffs. They were imposed under the American legislation referred to as IEEPA. Now, they were reintroduced pending an appeal. That appeal is due to be heard at the end of this month. It's going to be heard by, I think it's a much wider panel. I think it's about a 9-judge panel, kind of like a grand chamber of the ECJ. But the issue is that even if the original decision is upheld, the likelihood is that this is going to the Supreme Court, right? And that's any of these cases. That's where they're likely to end up. So it's going to be some time before we get a bit of clarity around it. I mean, two things that it introduces is that, number one, well, let's say ultimately at the Supreme Court, if those reciprocal tariffs are struck down, does that open the door to go back and reclaim back the duties that have been paid whilst they were in place? I think the second point to bear in mind is that, look, this isn't the end. Simply striking down the ability of President Trump to impose tariffs under that piece of legislation isn't the end. There's other legislation that's well available to the administration. The 232 tariffs, potential tariffs on pharma, motor vehicle, steel, aluminium. They're under different regimes, probably more secure in terms of any challenge. There's also a range of measures for President Trump to effectively decide to impose tariffs, but those are time limited. So I don't think it's by any means the end of the road. No,
and I suppose we've seen with this administration the desire to get things done, maybe notwithstanding the strict requirements. Okay, so one more here, Cillein, for yourself. This is just around what next steps Irish businesses should take to deal with all this uncertainty we've discussed.
Yeah, look, I mean, it goes without saying, uncertainty, upheaval isn't easy for Irish businesses, but I think inaction isn't an option here. I think Richard touched on some of the tariff-related measures, that kind of scenario planning, looking at your supply chain. There's a good playbook, I think, Richard, of custom valuation type, responses, and I think people definitely should be exploring those. I think US tax reform was that is certain. Now we have the rules, so I think modelling the new implications of that, working through those rules, understanding them. That's why it's so handy having Julio in London, the same time zone, a short plane right away for us to use when it comes to all these conversations. The usual thing, Susan, updating stakeholders, right, keeping the C-suite, everyone else up to date and involved. I also think advocating is an important one here, right? It's important that we all, as stakeholders, ensure that the interests of Ireland are upheld when it comes to OECD and EU conversations, and ultimately, that our own government, implement the right policy measures here to ensure that we remain competitive and the home of FDI.
Yeah, I think that's key, a key message. Okay, so look, we're just a little over time, so we'll finish up there. If you've any questions we didn't get to, we'll address them separately. I suppose just to sum up, there's a lot of changes we've discussed, and many will need a deep dive in the coming weeks as more details emerge. If we have discussed any issues that are relevant to your business and you have any questions, please do reach out to your usual KPMG contacts who will help you with that. Thank you all for joining us this morning.